At first, the definition of accounting. Accounting definition is very simple. Accounting is an art of information systems. Arts of information systems that identifies, records, summarize, and communicates the economic event of an organization to interested parties. This is the accounting. At first, economic events. Economic events means any situation, any occurrence. This is the event. When this event can sense by economics or economic value or measurement by economic value, this event is called transaction. So ultimately, we can see that the transaction at first identified. This is transaction or event that's identified. Then record. Record means primarily record, not permanently. Then summarize. Summarize means very short version. And summarize in trial balance, not details explain. That summarize and communicates to interested parties or interested user. Interested users may be internal users, may be external users. Internal, those who are involved or value creating the organization as internally. Manager, any others valuable stuff of an organization. And external parties, the third parties. No first parties, no internal parties, the third parties. Maybe government, tax authority, debtors, creditor, and like this, like this. This is external parties. Okay, next we will try to discuss, elaborate about this. Now I am going to criteria in identification of event to transaction. Just we identify event to transaction. This is event or transaction. We just try to identify at first. Is there any sense and financial position? At first, we thinking the event or contribute to change the financial position or not. If change the financial position, we recognize as a transaction. Otherwise, it is an event. Is it measurable in monetary terms? Then we try to think it is measurable by monetary terms or not. If measurable by monetary term, we call transaction. Say for example, you purchase a computer, you purchase a vehicle against a specific money. Okay, this money may be $3,000, $4,000, like this, like this. Is the sense the balance at least to account? The balance at least to account have or not? So for example, debit is equal to credit. We just try to think about this condition. When this condition are accommodation or adjusted, we can call the transaction. And against this condition, we can call event. So this is the main difference, event and transaction. Okay. I am going to try to example to clear the transaction or event. If event, no financial sense and no record. If sense, we try to record. Okay. At first, event, purchase computer, one kind of event. No clearly mentioned here exchange money or measurement money, only purchase computer. Discuss product design with potential customer. Just try to discuss with potential customer or bargaining or bidding or to take information about this. This is the event. No sense financial condition by this condition. Parent. Just you try to rent, pay by money or cash. Okay. So it is need to record because it is a transaction and discuss product design with potential customer. Potential customer, it is not transaction, it's an event. So no, this is no transaction. So don't record. If transaction, try to record. If event, no record. Okay. Purchase computer, definitely. Purchase computer, if you try to purchase computer, definitely against the money. Definitely you will give money. So this is the exchange. So financial condition have two sense. So this transaction have to record. So it is a transaction, yes. Okay. This is the example, event and transaction. Who is transaction we need to record and who is event no need record. Okay. That is the example. Each step in recording process. Recording process is step by step you have to follow to record. At first, analyze each transaction for its effect on the account. This transaction have or not effect on the account. If effect on account, it's the transaction. You analyze this transaction. How, what types effect on account. Enter the transaction information in the journal. Then the transaction try to record as a primarily. Primary book is a journal. Journal is the primary book where primarily record any transaction. Then the record on journal transfer to appropriate account in the ledger. Ledger is the kings of the account. Ledger is the permanent book of account because it's permanently record in ledger. So ledger is the king of account. Ledger is the permanent book of account. Okay, you mind it. No journal permanent record sources. Okay, permanent record source is a ledger. Accounting cycle is step accounting transaction is step by step try to record. So step by step recording process is called accounting cycle. At first, analyze the business transaction. Business transaction at first try to analyze.
Sorry, sir.
Yes. Have you any question?
May you maximize?
Yes.
May you maximize it?
Oh, you feel.
Yeah, it is a. I can't read it.
Oh.
So you can give the slideshow. It will be easier to read.
Okay.
You cannot see my slide.
I can't see it very well because it's very small.
Very small.
Yeah.
Maybe check your device because other student you clearly or my sound or slide okay or not?
It's okay, no problem. But I would prefer that to see it very nice to make it maximize the if you can.
Sir, if you can give the slideshow, then maybe it will be very clear, sir.
Okay, sir.
Sir, assalamu alaikum, sir. Will that be journalized or generalized, sir? Point 2, the accounting cycle.
Accounting cycle, point to journalize. Journalize. That means journal plus participate. Journal plus IJE. Zero participate like the sentence pattern. Okay. Convert in journal. That's mean.
Right, sir.
Analyze business transaction. Business transaction analyze. This is event or transaction. Event or transaction. You just primary stage or recognize stage at first. Then you try to record it primarily or firstly in journalized transaction. Okay. Journalize means record in journal. The recording process of journal is journalize. Next step,
স্যার মানে লিপিবদ্ধ করা বা এরকম কিছু বোঝাচ্ছে স্যার নাকি
লিপিবদ্ধকরণ, recording.
ওটাকেই স্যার জার্নালাইজ বলে স্যার?
Yes, yes.
স্যার থ্যাংক ইউ।
Recording in journal. That means journalize. Post to ledger account. Ledger account is a permanent account or permanent book.
Sir,
After
Sir.
journal, then try to post to the ledger, the transaction. This is the ledger account.
excuse
Okay.
me, sir.
Okay.
স্যার একটু স্লাইড শোটা প্লে করে দিলে একটু দেখতে একটু সুবিধা হতো স্যার।
Slide show.
ডান দিকে নিচে ওই যে কাপের মতো যেটা আছে স্যার ওখানে ক্লিক করলে স্লাইড শো।
I know,
Sir, sir.
but okay,
থ্যাংক ইউ স্যার।
okay.
স্যার বেটার স্যার বেটার।
So prepare trial balance after ledger. Try to post to the trial balance. Trial balance is a summary. Trial balance is a summary stage. Then adjust entries. Try to adjusting entry or adjusting journals. After trial balance, posting to the adjusting entries. Okay. After adjusting entries, adjust the trial balance. Adjust the trial balance. After adjust trial balance, owner equity statement or balance sheet. Okay. Prepare financial statement. After adjust trial balance, we try to post or transfer to the financial statement. In a financial statement, there are minimum 3 stages: income statement, ownership statement, and balance sheet statement. Income statement, expense and income. You are classify here and try to find out the gross profit, net profit. Then ownership equity, the ownership position. Then balance sheet, liability and asset. You are design here and try to know the financial position of an organization by a balance sheet. Then journalize and post closing entries. At the end of year or at a time, you have to need to close the entries. This is the post closing entries or post closing journal. Then prepare post closing trial balance. At first, you again check asset and liabilities are equal or not. If equal, then okay. If not equal, you check and recheck, and then you try to surplus or shortage make, okay, or compensation. This is the accounting cycle. This is the accounting cycle. Activities in accounting. A very easy questions. Activities. What is activities are done by accounting? Identification. You have to first identification. This is transaction or event. If transaction, you try to record. Okay. Then recording. Recording at first. Primarily, you try to record on a journal book. Then next book, next, and process the going on in a recording space. Then communication. Communication to the interested parties. Who is communication? By a proper report. Proper report. What is the report? Income statement report, balance sheet report, ownership statement report. By a report, gross profit, net profit, owner's equity, dividend, like this, I report to the interested parties. Okay. So we use the accounting data. Accounting data, there are 2 parties, internal parties and external parties. Internal parties, those who are involved or they are value create in an organization, or the keynote as internally, say for example, production manager, marketing manager, directors, chief executive officer, GMG, like this, top authority. External parties and third parties, government, tax authority, and other parties, those who have no external information. This is the external user of information, external user, investor, creditor, okay, tax authorities, regulatory agency, labor union, customer, like this. Now I am going to another important information about the accounting is the types of account. Types of account, basically we know there are 5 types of account: assets, liabilities, equity, revenue and expense. Asset, cash, property, equipment, vehicle, and account receivable. Account receivable means we get a future benefit. We receive the future benefit, account receivable. We will get in future, okay. Liabilities means a liable to pay in future. Bank loan, account payable, credit card, unearned revenue earned but not paid to till now. Customer credit, like this. Equity means owners party. Owner's equity, owner's drawing, owner's contribution. Owner's contribution is a capital, okay. Common stock and retained earnings. Revenue, income inflow in organization. Which item inflow income is a revenue. Sales, anything sales, product sales, property sales, asset sales, like this. Royalties, cost of goods sold, expense. You just paid cash to run an organization every day or day by day, running the organization, which amount you are sacrificed or you paid. It is the expense. Wages, rent, phone bill, and utilities. A huge expenses, huge revenue, asset, liabilities, equity, huge, but some or basic a point I try to highlight here. Okay. Asset and expense. We know that there are mainly 2 types of assets. At first, current asset and long-term asset. Current asset, cash, inventory, account receivable, trade debtors, note receivable, receivables, account receivable and note receivable. Account receivable means the oral promise to get in future, and note receivable, written promise for the writing proceed. Okay. Prepaid expense, but you advance cash pay. Accrued revenue, you gain revenue but not take cash till now. You will get the cash future, but income already earned. Supplies is stationary or very simple or tiny expense on your organization. Prepaid insurance, like this advance insurance, prepaid and advance, always time asset. Okay, you paid in advance. Short-term advance investment. This is a current asset. And long-term asset, equipment, furniture, fixture, land, building, car, vehicle, plant and machineries. Long-term investment, air condition, like this. Okay, those item we will get the future benefit more than 1 year. Example, expense. Salary and wages expense, travel expense, rent expense, miscellaneous expense, advertising expense, supplies expense, depreciation expense, insurance expense, interest expense, utilized expense, maintenance and repair expense, property tax, cost of goods sold, operating, freight out. Freight out means transport by sale, and freight in, transport when you try to purchase or buy. versus rent expense, traveling, conveyance expense. This is the example of expense. Ownership equity account, ownership drawing, anything taken from business by owner. By owner, anything taken is it as a drawings, and drawings always time minus from capital. Example of revenue, gain, income, sales revenue, service revenue, fees earned, interest revenue, commission revenue. Example of income or revenue. Example of liabilities, notes payable. All payable are credit, okay, or liabilities, all payable. Notes payable, account payable, account payable is a written condition, not written condition, oral condition, and notes payable, written condition. Salaries and wages payable, all types of payable are liabilities. Okay, current payable, interest payable, are unearned revenue, unearned revenue. We mind it. Short-term loan, accrued expense, property tax payable, like this. Long-term liability, mortgage payable. You just take a loan from a bank, you something keep in bank. It's a mortgage. If you don't pay within a time, bank have a right to sell other to get money. This is the mortgage condition. Loan, bond, debenture, owner's capital, cash or other asset provided into business by owner. By owner, anything give, cash or asset, this is a capital. Or anything taken by owner's drawing, treat as drawing. Accounting equation. Accounting equation is a summary of all accounting. All accounting summary is a equation. Equation, there are two side, left hand side and right hand side. Left hand side asset, right hand side liabilities and owner's equity. Okay, this is the equation. Asset, different types of asset, liabilities. You try to heading different types of liabilities. Owner's equity, there are different types of heading or column. Okay, but here are very simple. Single column try to highlight asset is equal to liabilities plus owner's equity. This is the extended accounting equation. Asset is equal to liabilities plus owner's equity. Asset is equal to asset, different types of asset and different heading you have to design when you try to practice the mathematical problems. Then liabilities, different type of liabilities you have to design or different column liabilities. Okay, plus capital, owner's equity. There are two parts again. Capital one part and another part retained earnings. Okay, and retained earnings are the impact revenue. If revenue, retained earnings plus expense minus retained earnings, drawings minus retained earnings. Okay, so you carefully mind it. Owner's equity, there are two parts. One part capital, another part retained earning. Retained earning, there are three items you have to impact. Revenue plus, if revenue plus, if expense minus, and drawing minus. Okay, asset is equal to liabilities plus capital. This is the extent accounting equation. Okay, asset increase, asset decrease, liabilities decrease, liabilities increase, equities increase, equities decrease. Okay, you just carefully mind this formula. Asset debit for increase, if asset increase, debit. If asset decrease, credit. If liabilities decrease, debit. If liabilities increase, credit. Equities increase, credit, decrease, debit. Okay, asset debit, that means plus, asset credit, that means minus. Liabilities Debit, that means minus. Liabilities, credit, that means plus. Equities, debit, that means minus. Equities, credit, that means plus. Okay. You have to memorize this form. Otherwise, you cannot solve the equation. Okay. Very carefully you memorize this. Okay. Okay. Maybe today lecture I try to finish, but if you cannot understand the equation form or equation sum, you cannot solve the mathematical problems. Okay.